evening and welcome to Taking Stock here on ENCA. They call it the divide between Wall Street and Main Street. It's as applicable in the United States as it is here. The gap between what's happening in the real economy, which is contracting very, very quickly. We could see a decline in the economy of as much as 10% this year, and the rocketing stock market, which collapsed so spectacularly in March and April and saw a massive recovery in late May and into June. This big recovery on stock markets is hard to explain. So we've got three people to explain it to you this evening. We've got Dr. Adrian Saville standing by. He's Chief Executive at Cannon Asset Managers. We'll talk to Leila Fourie, who's Chief Executive at JSE Limited, and Chantal Marx, who is with FNB Wealth and Investments, to take you through the difference between what's happening in the economy and what's happening on stock markets. Well, first this evening, Dr. Adrian Saville, who is Chief Executive at Cannon Asset Managers. But you've been in markets for a long time, Adrian Saville. Have you ever seen such violent ructions in economies and stock markets all at the same time?
In the world of investments and finance, they talk about crocodile jaws. And you can think of something running upwards and something running downwards. And the crocodile jaws here is the disconnect between the economy and markets. I would suggest you've probably got to go back to the late 1990s to the tech boom and bust to get a similar disconnect between the industrial circumstance and the valuation that we saw on companies. This is much broader based. It's almost economy-wide and industry-wide. But the difference between what markets are saying the world looks like and what the world really looks like, it's a gaping deficit.
It's what they call the gap between Wall Street and Main Street. Wall Street representing high finance and Main Street representing the real world where people live and operate and run businesses and try to survive on a daily basis. And that chasm, and it is a chasm, has possibly never been bigger. And certainly it hasn't grown to the extent as quickly as this has, because the short, sharp shock on the economy caused the stop of 3/4 of the world's population suddenly at the end of March. And as we start slowly opening up, stock markets have run way ahead of this reality.
No, Bruce, I would look, in part, the response is perfectly understandable. You've got Alan Greenspan's put on steroids here. The Greenspan put refers to any time Wall Street went into a stressed zone, the Fed would cut rates. And it's attributed to Alan Greenspan as being the author of this. And you've got here a Greenspan put on steroids, and it's been a concerted effort. It's not just the Fed, it's central banks around the world have responded with very, very aggressive monetary policy stimulus. And at the same time, you've got fiscal policy stimulus. So there's an easing of interest rates. There's central banks stepping in to help capital markets through all of their distress and anxiety. And at the same time, you've got governments spending fiercely. So I think that those help explain some of the relief and the recovery. But what's very difficult to reconcile is that businesses today, this side of June, are not the same as businesses that side of January, but the valuations are back as if nothing to see here. Folks, let's move on.
How much does that scare you? I mean, as an investor in stock markets, how and what are the consequences of this disconnect? Because surely all it means is, unless economies play catch up really fast, and they've lost 1/6 of the year at least, possibly going to a quarter of the year if this drags up much longer, that we go back into some kind of free fall again.
Well, that's when the news will sort of catch us up with the current circumstance. And the current circumstance is exactly as you paint. It's not a slowdown, it's a sharp decline in activity across industries, some industries into almost complete decline. It has to translate into forget about accounting, reported earnings. Those are always interesting. What you really want to look at in this environment is cash flow and balance sheet. And cash flow has to be zero. I'm not sure where you're going to get cash flow from if you don't have customers. And look, there is a thawing and a restarting, but what we've gained from the Chinese experience, the first in, first out, is that thawing and that restarting, even some weeks after the restart, they're still 20% off where they would otherwise have been. So it's a very, very gradual return to normality, and I'll use air commas because I'm not quite sure what normality is. But what we've experienced now has not yet been reported. And to me, I think that's the thing that is really going to turn heads, is when that financial reality hits the print.
And certainly in South Africa, we've seen much of what you've been talking about in terms of the United States and the Greenspan put, because our Reserve Bank has taken unprecedented action in unprecedented times, for a word that's been used an unprecedented number of times over the last 3 months. And that is and the Reserve Bank not only cutting interest rates, but also agreeing to buy government bonds, to be the buyer of last resort. And that seems to have kept us from calamity. It's been a smart and appropriate strategy.
Look, I'm not sure that we have been kept from calamity. I think we're in it, and that we are in a very stressed economic circumstance. I think the extent of a crisis has been managed or mitigated, that it would have been much deeper were it not for the fiscal stimulus and the monetary stimulus. Those have helped, but they have not prevented. And as the South African economy thaws, I think those realities are also going to land, and they are harsh realities. Our numbers point to economic growth that is a double-digit decline, a budget deficit that's 15% of GDP, and unemployment figures comfortably go into mid-30s and possibly heading toward 40% official unemployment. Now, that's the narrow definition. And then to go to your word, unprecedented, that puts us in unprecedented territory. It's very hard to escape the conclusion then that South Africa is in economic crisis. We're not in financial.
And therefore, our response as a country is absolutely pivotal to this. And without radical transformation of the economy, I don't want to call it radical economic transformation because that's something completely different. We have a couple of really interesting to make right now.
And I don't think that calling South Africa in crisis right now is sort of radical or extreme. If you describe a country that has exceptionally stretched inequality, very concentrated industries, 30% unemployment, zero economic growth per capita for a decade, that's a country that is in real trouble. Perhaps, the silver lining on COVID is it has made it unequivocally clear that something has to change and that the country has to reposition and must reposition quickly. And so then you can start ushering in Tito Mbowene's 77-pager that he produced, that Treasury produced at the end of last year about the structural transitional transformation.
Dr. Adrian Saville, thank you very much. He's our first guest this evening here on Taking Stock. In a moment, Leila Fourie, Chief Executive of JSE Limited. They have seen huge dislocations happen in markets. And later on, Chantal Marx from FNB Wealth and Investments on Taking Stock. And now to the Chief Executive of JSE Limited, the company that runs the stock market. Leila Fourie is on the line to us and taking stock this evening. Leila, it's been such a tumultuous 3 months on the stock markets. We were chugging along very, very nicely in January and February. Suddenly, markets fell off an absolute cliff, and the recovery has been quite extraordinary. Just take me through what happened to JSE Systems in those early days of capitulation, where the JSE fell 22, 23% in a matter of weeks.
Yes, indeed. Bruce, I think it was probably one of the most tumultuous experiences that we've had as a market. We had our deepest loss on the 19th of March, where we were down 33%, and we gyrated between being down almost 10% to being up by 8%, which was our highest ever gain in the market. And just to give you a sense of the sort of volumes that we were processing through the exchange, on average last year, we processed around 300 million deals a day. During the month of March, we hit as high as 800 million, and on average, we were processing 600 million. And these volumes were all processed by both JSE staff and market participants who were working, like you and I are today, from the comfort of our homes. And it's quite extraordinary to contemplate volumes of that nature and still see systems that are working and credible. We did see many of our peers globally who had some quite significant issues in processing those volumes. So as a country and as a financial ecosystem, I think we can all be pretty proud with what was achieved.
Well, for people who don't understand the importance of systems holding up and systems maintaining, is if I want to buy something and I see a price on my screen and I want to buy it at 100 and I get a 3-hour delay, a 3-minute delay, and the price goes from 100 to 120, Sasol would be a good example over this period, for example, where I might have wanted to buy at 25 and before I knew it, it was 50, 100 and 150 and beyond. You are prejudiced then in the market. And the idea there is to ensure that trades are executed immediately for both the seller who wants to get out and the buyer who wants to get in.
Bruce, indeed, we as a country punch way above our weight in the volume and value that we process, and we have an enormous international community that invests in our market. And so the integrity of the capital markets is really vital, and it's on two parts. Firstly, that the price that you see is genuinely the right price, i.e. they're not systems constraints that are delaying prices or that don't enable you to trade when those prices are at the right level. And then secondly, that when you trade with a counterparty, with somebody else, that indeed that trade will settle. Now, because we have a very unique market in our country, in that we have massive dual listed counters, we are often at the epicenter of short trading globally, because many of the internationals see our local dual listed stocks A, as rand hedges, and B, as a very good exposure to the emerging market environment. And because South Africa is such a deep and liquid market relative to many of our other emerging counterparties, you see a massive flood of short trading from internationals, and we indeed experienced that. And
does that explain that really, really rapid decline? And then as people were discovered that they were short and then had to go and buy the shares to cover those shorts, we're getting technical here, but that explains then also possibly the spike upwards too.
Actually, funny enough, that's a big point of debate, because many people believe that short selling drives the price of shares down. But what research has indicated is that long sellers are actually the source of a tremendous downward pressure. And so short selling, based on the research that has been done, does not contribute more to price dislocation than long selling. But what short selling can do, if customer hasn't gone in and borrowed stock to settle their trade, it can cause a settlement delay, and that causes enormous confidence issues in the market. So if South Africa cannot settle trades, that creates reverberations across the global economy, and speculation that potentially that inability to settle is because of some large default about to happen. And so our ability to settle is fundamental to confidence in the exchange, and particularly when you have a large number of internationals trading the market as we...
You mentioned internationals, and of course, in the last 3 months, not only have we seen huge fluctuations on stock markets across the globe, including in South Africa with that sharp drop downwards and then a quick recovery back to levels that we saw just before the crisis really began. But internationals have been big sellers of our bonds as a result of us being kicked out of the World Bond Index. They've also been big sellers of South African shares. Those movements have been accentuated. Are they coming back or are they staying out? Do we have a lower percentage of foreign investors in South Africa now than we did 3 months ago?
We've seen extraordinary volatility, particularly in the bond market. So in the month of March alone, we saw 55 billion net outflow in the bond market. And that compares to last year for the entire year, where we saw 22 billion. So more than double the entire year's flows in a month. That said, in the last June month to date, we've seen net inflows of almost 4 billion. And so I think what you saw in the month of March, and ironically, up to the downgrade decision, not necessarily as much post the downgrade decision as it was pre the decision. So obviously market participants pricing in the move, the expectation was that we would be downgraded. And if you look at our bond yields of anywhere between 7 and 9% for, depending on the day you look, for our 10-year bonds, we are trading, those yields are well above our peers in the same rating grade. And so like we saw a couple of years ago in Brazil, where bond yields went from 16% down to less than 8%, there is a strong likelihood that we see, and indeed in June we're starting to see, a search for yield by the rest of the global economy, a bit more of a risk-on appetite, and investors globally starting to look for a bit more yield given the crisis of growth that the developed world is facing into right now.
That leads us very neatly into Chantal Marx from FNB Wealth and Investments. We'll talk to her in just a moment on taking stock. And wrapping up this evening, Chantal Marx, who is with FNB Wealth and Investments, the three horsemen of the regret apocalypse, Chantal. I could have, should have, and would have. Did you buy Safil at 25 Rand or wherever it finally fell to? Or are you like the rest of us?
So I didn't quite buy it at 25 Rand, a little bit more than that, but I wouldn't have bet the house on it. And I think I said so much a few times. At the time, it was very difficult to see whether or not Sasol will have to come to the market for additional capital. And that destroys a lot of value. So it's very difficult when you have something that we term poor earnings visibility. And if you don't have earnings visibility, it's difficult to make that call. So coulda, woulda, shoulda. I think that a lot of people are very happy today, but best they take a bit of their capital off the table, I think, if they got in at 20 Rand.
Yeah, here's the thing. I mean, you talk about earnings visibility. In our stock market at the moment, there is zero earnings visibility unless you visible zero, because companies have had no cash flow for months. Companies have fallen very, very hard. And you just look at all of the trading updates and the results statements that are coming out of companies. They're not even daring to forecast the future. And if they were not prepared to do that, how are the rest of us meant to?
So I think that they're not comfortable forecasting the immediate future because we don't really know when the COVID-19 story will end. We don't know exactly how long and how deep the consequent recession will be, because there will be a recession and it will be significant and it will hurt these companies. But what we can say is that we think that at some point in the future, and I'm not talking about 5 or 10 years, I'm talking about the next 12 to 18 months, there will be some sort of normality that will return to everyday life. And a lot of these companies where you can't see immediately what the impact will be, you could say in 2 to 3 years' time, things should normalize. And if they are going to normalize, then there is still value in some of them.
The question is which, because we look at, for example, our South African banking sector, valuations are so tempting and so delightful, yet their earnings visibility is very, very hard to predict. South African retail, very hard to predict. Gold mining companies, not investments, speculative tools, possibly the resources sector, but we don't really know what happens in trade wars between China and the United States. Do we do the cowardly thing? And I've been doing some personal research on this recently and looking at the massive underperformance of index funds as they fell more quickly than many managed funds, and then the rapid outperformance of the same index funds as we've gone into this very, very quick recovery. It feels like the only place to be right now. And I know that's swearing at somebody who picks stocks for a living, but for the rest of us, it feels like a mug's game.
Yeah, I mean, absolutely. I think just when it comes to index funds, you need to know what you are buying as well. So if you are buying an ETF that tracks the JSE, for example, a very big chunk of that performance will depend on the very largest shares in those ETFs. So it will depend on what your view is around Naspers. As stock pickers, our view on Naspers is quite positive. So perhaps that is a low-cost, easy route to take. But usually when earnings visibility is poor and there's a lot of uncertainty around the future narrative and how the world will look, it's a lot better to go and focus and dig for those companies that you know for a fact will make it and could even benefit from conditions as we find ourselves in right now. Over the
last quarter, Chantal, I mean, the outperformers are completely counterintuitive. Companies that have been boxing with one hand tied behind their back and their legs tied together for so long, with bad news and bad news and bad news, suddenly the news goes catastrophic. Some of them take some fairly radical measures to restore their fortunes over the long term, and suddenly these are the guys who are outperforming. It really is quite hard to assess the nature of the market sometimes.
Yeah, I think with those stocks specifically, they were just sold off so heavily in the first quarter. I mean, some of them were heading what seemed like towards zero. And if you are going to look at some of these stocks and whether or not there will be an eventual future for them, then the answer is yes. I mean, I was just thinking about Sun International and Torkel Sun. Big, massive moves, but still down so far year to date and so far over 1 year. But will people not return to Monte Casino? Will no one ever go to the Palace of the Lost City again? I doubt it. I think the world will normalize, and I think those are the sorts of trends that punters are identifying currently. I'm not personally invested in that space. I'm at the moment still trading on the cautious side, and it's all about balance sheet from my perspective.
But what's critical here, Chantal, and I think what all of us need to do as we look at our retirement annuities, as we might have, if we're lucky enough to have some unit trusts, or if we are buying shares from time to time. I get lots of emails from people saying, should I be buying this share right now? Sorry, I don't respond. But it's a case of understanding that this is a dreadful, dreadful global anomaly that we're going through right now. And as you say, maybe 12, maybe 18 months, maybe slightly longer, maybe slightly less if we get some sort of COVID cure. Life continues. And it is at times like this where people like you actually start rubbing your hands with glee at some point. My sense is you're not rubbing just yet.
Yeah, no, I think when it comes to the equity market, I think that there could still be a second leg down. I think it's come back quite strongly, both in South Africa and internationally. That pain is still going to be there over the next 12 to 18 months. And those really nasty looking earnings numbers are still going to come through. And I think that you might see a big negative market reaction once they do start coming through. I think for now, try and take the opportunities as they come. Some stocks will still offer value at current levels, and perhaps look at diversifying your portfolio as well. There are other asset classes, and I think that you need to start looking at them also, especially during times like these when we aren't really certain what the next 12 to 18 months will hold.
At that point, we are going to have to leave it, Chantal Marx. Thank you very much indeed. With FNB Wealth and Investments. Before her, we had Leila Fourie, Chief Executive of JSE Limited, and started this evening's edition of Taking Stock with Dr. Adrian Saville at Cannon Asset Managers. That is it from us here on Taking Stock for this evening. Thank you very much for watching. Till next time, bye-bye.